Hello and welcome to payroll accounting, specifically Social Security taxes in this lecture. As I move through this lecture, I will actually be bringing up some of the examples from the book and we'll work through them where they're applicable. And I will be accessing PowerPoint and Excel, and we'll get this rocking and rolling. We will be learning specifically about Social Security taxes. These taxes are the ones that cover and contribute funding to the Old Age Survivors and Disability Benefits Program and the Retirees Health Insurance Program. There are two acts that actually impact these taxes, and we will take a look at both of them. So here we have the general FICA coverage. We've talked about this a little bit before you've been introduced to it. There are two parts to this tax. There's the Old Age and Survivors and Disability Insurance Program part and the hospital insurance, which is more commonly known as the Medicare program part. Taxes are paid both by the employer and the employee. Employees pay 6.25% to OASDI and 1.45% to HI. With the exception of an additional 0.9% that is applicable for high wage earners over $200,000. The base of 6.2 and 1.5 is also contributed at the expense of the employer. So how this works is that the employer withholds the employee's portion from their paychecks and remits it to the program for the employee. They remit this at the same time as they pay their matching expense. So I guess first and foremost is you have to figure out who does FICA apply to. And there are three parts to this. First, we have to determine is the individual an employee or an independent contractor? Is the service that's rendered considered employment, and is the compensation considered taxable wages? Most workers in the U.S. are covered under FICA. But first, these questions do have to be answered. The individual must be considered an employee as defined by the common law relationship of employee and employer. If you'll recall back that there are some stiff penalties for misclassifying an employee as an independent contractor, and we'll talk about that a little bit more towards the end of this particular chapter. Service and taxable compensation are defined in FICA law, and we'll look at those a little bit further as well. The definitions of a covered employee and covered employment tells us who will pay taxes at what rate and who will ultimately be entitled to receive benefits at some point in the future. Covered employees, regardless of their status, be they full-time, part-time, or seasonal, are taxed in the same manner. So even if you have a seasonal employee, they are still subject to the FICA taxes, and you still must contribute your portion of FICA taxes. So first, the employer. Every person is an employer if the person employs one or more individuals for performance of services in the U.S. Since FICA has a provision for taxes to be levied in regard to wages earned by employees to be paid by both employers and employees, we need to define what an employer is to begin with and how it relates to employment. Every person is an employer if the person employs one or more individuals for performance of services in the U.S. Person is a general term, and this encompasses a variety of entities, all the way from actual individuals like sole proprietorships to trusts, estates, partnerships, corporations. So when we see the word person in relation to FICA taxes, it doesn't necessarily mean an individual. It means an entity. Employment applies to any service performed by employees for their employers, regardless of the citizenship or residence of either. The determination of the employee-employer relationship or an independent contractor status, which we'll talk about here a little bit later, is the responsibility of the employer and applies to more than just Social Security taxes applicability. It also influences FLSA coverage, withholding obligations, workers' compensation, and unemployment taxes. Making this determination according to the law is very important. The common law test is based on history and currently is represented in 20 factors. There are copies of these documents in your resources. But what it boils down to is that in essence, if a person has the right to tell a worker how, when, and where to work, the worker is considered an employee. Now, there are some employment relationships that are firmly considered the employer-employee relationship that are deemed exempt from FICA for a variety of reasons. Take a minute to peruse this list and digest it. As you can see, the exemptions are largely related to student employment or to a form of government or other retirement act. Okay, if you've not yet made it through this list, go ahead and press pause so that way you can give it a really good solid perusal. Moving forward a little bit more, we're going to talk about the covered occupations. These technically are considered independent contractors. But in addition to those exemptions to not being covered, as we saw on that last slide, there are provisions to cover certain occupations where under the common law test, the individual is an independent contractor, but is considered an employee for FICA coverage. Rules, laws, acts, nothing can be easy in black and white. These individuals are covered unless they have a substantial interest in the facilities used in connection with their job, or if the service consists of a single transaction only. And these individuals are people who are full-time life insurance salespersons, agent and commission drivers of food, beverages, or dry cleaning, full-time traveling salespersons, and individuals working at home on products that the employer supplies and are returned to furnished expectations. And then there's more complexity. The evolution of laws, rules, acts, and applicable programs has created some additional specifications. Government employees have differing elements of FICA that might or might not be applicable as a result of their coverage under other public plans in regards to the data hire. Kind of generally, anybody after 1991 in any government capacity that is not covered under another retirement plan like PARA is subject to full coverage. They are part of the public retirement plan, then there are other provisions at play. Impatriates are foreign citizens that are subject to taxes similar to Social Security in their home country that have been transferred to their employer's home country in the U.S. and are working here. They are not subject to FICA taxes if there is what is called a totalization agreement in place. If there is not an agreement, the worker is then subject to FICA. Currently, we have more than 20 countries in which there is a totalization agreement in place. Expatriates are employees that are U.S. citizens that are working on foreign soil for a U.S. company, and they are subject to FICA and may be also subject to a similar tax in the foreign country, depending upon the rules and laws in place there. Children who are under the age of 18 that are performing work for a parent are generally considered exempt from FICA. And if the work is not in the course of the parent's business, that age threshold will actually extend to 21. This particular exemption does not apply if the entity is a corporation, a partnership with a non-parental party, or an estate. And now we have just a tad bit more when it comes to specific situations. So, household employees. If they make cash wages of $2,000 or more per year, then you must pay if the domestic employee, like a nanny or cook, is under your control. For household employees, this control does not have to be actually exercised, just the right to do so must be present. Some examples of household employees are babysitters, caretakers, cooks, drivers, gardeners, nannies, housekeepers, and maids. Additional exemptions are inmates, medical interns, student nurses, and workers serving temporarily in the case of an emergency. So individuals that are in the learning capacity, such as medical interns and student nurses, are exempt from FICA, as are inmates that are earning wages for services provided in penal institutions. There are some special considerations for religious practitioners, such as ministers, but this is a rarely encountered situation. We're not going to see this all the time. And although charities, some hospitals, and a bevy of other organizations are deemed as not-for-profit, the employees of those organizations are subject to full coverage for FICA. So the employees will have FICA withheld, and the company will have to remit FICA taxes on behalf of those employees. So just kind of a quick general wrap up here on FICA. Both the employer and the employee contribute to FICA. There are two elements of the tax of 6.2% for OASDI and 1.45% for HI. This is the amount that is applicable to both at all times. There is a high earners additional supplemental health insurance or hospital insurance tax that comes into place if the person earns over $200,000. And an employer-employee relationship is present. But what about those people that are not considered employees? Those self-employed independent contractors. We will actually be talking about them here shortly. But before we jump over to the self-employed, let's just look at what happens if there's a misclassification. When there is a misclassification, this means that an employer has been treating an employee as a self-employed, meaning they've not been withholding FICA taxes, nor have they been remitting their portion of FICA taxes. They will not have been withholding any other type of income tax, and they will not have paid work comp or unemployment insurance taxes on this type of an individual. From a FICA perspective only, the penalties that come into play. And this is if they classify an individual that is legally an employee under the tests as an independent contractor. The employer will have to pay the employer's share of FICA taxes plus income withheld from the employee. That doesn't read right. My apologies. And taxes not withheld from the employee. If the employee reported this income on their 1040 and the SECA taxes were collected here, the penalty is avoided. But if the employee did not report, but the employer issued a 1099 miscellaneous, the penalty can be reduced. Now, this can actually become much more expansive, and there's just a little bit more of a penalty that can be at play. So before we move on from here, I just want you to take a minute and kind of digest all the different things about Social Security, who is an employee, who is not an employee, and what to do, what can happen if there is a misclassification. So now you're thinking, okay, every employee is subject to 6.2% OASDI and 1.45% of HI. The employers are contributing the same amount as well to Social Security, but we have so many sole proprietorships and a lot of self-employed people in the United States. Are they paying their share? And that's a great question because these are employment taxes, and we are talking about payroll. However, just so that you are aware, we'll move forward and really talk about the independent contractor perspective as well. So the independent contractor, this is 10 points of the test of an independent contractor. And an independent contractor is an organization, and if it's an individual, they can be considered self-employed. So if they are self-employed, and this is the area we're going to talk about it. So we have Joe, who provides snow plowing services. He owns his truck. He owns his plow. It's just Joe. He's not a corporation. He doesn't have any employees of his own or any of this other things that come into play. An individual can be classified as an independent contractor if they conduct an independent trade or business. Generally, this means that the person is providing services to someone else who's paying for those services, and the paying person has the right to control or direct the result of the work, but the means or method of accomplishing the work lie in the hands of the individual, of the independent contractor, the person who is being paid. This status is subject to those previously spoken about common law tests that are provided by the IRS. And a status as an independent contractor indicates that according to the individual facts of each case, this person meets that definition. The hiring party does not pay the employer portion of FICA taxes or withhold any of the employee portion for FICA tax on the payments that are made to the independent contractor. The independent contractor is deemed responsible for their own Social Security taxes on net earnings underneath what we call CEQA, which is the Self-Employment Contribution Act. So these are just a few of the different ways you can tell workers might be classified as an independent contractor. All of these may not be in play in every situation. And remember to go back to that common law test. Now, CEQA, the Self-Employment Contributions Act, is a tax upon net earnings of the self-employed. They must pay 12.4%, that is the 6.2% employee portion, and the 6.2% employer portion of OASDI, and 2.9% of HI, which accounts for the 1.5% employee and the 1.45% of employer, with a caveat here as well that if self-employment income and wages or self-employment income alone exceeds $200,000, then they will have to pay that additional 0.9%. Individuals who are not employees, who are deemed legally independent contractors, are considered to be self-employed. Someone can be an employee for one organization where he works 9 to 5, Monday through Friday, but in his off time, he's engaged in services to others where he is considered an independent contractor. So our friend Joe, who is our independent contractor, he takes care of snow plowing for us. Maybe Monday through Friday, he's driving a cab, and he works as an employee driving a cab. but he has his own little side business, and that's where the self-employment comes in, only at the side business side. In addition to IRS filing requirements regarding income and expenses for federal taxes, these individuals that are self-employed are also going to pay this CEQA tax. This tax funds to the OASDI and the HI programs the equivalent total of what an employer and an employee would contribute. It's calculated to net earnings, not gross earnings, but it is a potentially significant factor for the individual to plan for when it comes time for them to file their tax returns. So self-employment income is reported on the Schedule C, Form 1040, to the Schedule SE with the Form 1040, and examples of both of those have been loaded to your resources. Self-employment taxes are applicable to 15.3% of net earnings that are over $400 annually. Anything under that, the CEQA taxes are not applying. The $127,200 limit for OASDI actually applies to the combination of both W-2 wages and self-employment income. So there may become a situation where between the amounts that were earned with W-2, where they may not actually be paying OASDI because they may have met that limit already. CEQA does not apply to all payments made to or received by the independent contractor. These payments represent the gross earnings of their business activities. In the course of providing their business services, an independent contractor incurs regular business expenses. These expenses are deducted from their gross earnings to derive at their gross income subject to taxes. This is all applicable to IRS allowances for business deductions. For sole proprietors, this is their gross income. In the case of a partnership, each individual's pro rata share of the business income, whether distributed or not, is the individual partner's distributive share of business income and is subject to CEQA taxes. The applicable CEQA taxes are 15.3% total. And we are going to go ahead and look at an example problem dealing with this. So for those that are using the book 2018 edition Payroll Accounting by Big and Tolan, we're going to be looking at problem set B, number 3.8. And for this problem, it says George Parker was paid a salary of $74,700 by Umberger Company. In addition, during the year, he started his own business as a public accountant and reported a net business income of $60,000 on his income tax return for the year. We are going to compute the amount of FICA taxes that was withheld from his earnings during the year by Umberger and his self-employment taxes on income derived from the public accounting business for CEQA. I will launch up a spreadsheet here real quick and we will look at how all this will work out. Now, it's important when you broach a problem to remind yourself of some of the salient facts. So, for example, in this case, Mr. George Parker has both employment and self-employment income. So don't forget that there is a maximum of $127,200 in taxable income that OASDI applies to. And that is in both situations. or if you have both at play, cumulatively. Oh. So we know that there is an OAS DI max of 127,200. So here they want us to look at what was withheld from his earnings from his company. So these are amounts that he doesn't get to direct them. He does not get to say, only take this much because I also have self-employment income. When they're withheld from the employer's side, up to $127,200 will be subject to OASDI. So he received a salary of $74,700. So he has wages of $74,700. Because those are less than the $127,200, they will be applicable for OASDI. Now you'll recall that HI does not have an upper limit like OASDI does. In fact, it actually has a threshold that will kick into place if you exceed that 200,000 mark. So he also has wages subject to HI of $74,700. Now the employee portion of OASDI is 6.2%. And the employee portion of HI is 1.45%. Therefore, the amount that was withheld would be his wages times the applicable percentage of $4,631.40 of OASDI and $1,083.15 of HI. The complexity comes into play here when we start talking about the second source of income. So employees can work at multiple companies. A lot of you may have been in this situation before where you had a regular job and then maybe a weekend job too. So you're going to pay OASDI attributable to your wages at that company. If you were to exceed the 127,200 threshold in that year, then what would happen is that you would receive some of it back with the filing of your tax return. Now, this is on an individual basis. That cap is $127,200 per person, not per married couple. So just so that you're aware. So the second part is coming into the self-employment taxes. So he is going to receive a credit on his federal income tax return for these paid taxes that were derived from the accounting business. So he's going to need to pay for some of this. So first we have to figure out how much of his income of $60,000 is actually going to be considered taxable. So we start with the his full net income of $60,000. And then we are going to determine for what's taxable. This is at the OASDI level because it has the threshold. So we take the threshold and we remove from it the amount of wages received. And that tells us that of his $60,000, $52,500 of it will have OASDI attributable to it. Remember, there's not a limit for HI. So the full $60,000 will be taxed at 3.9%. However, only 52,500 of it will be taxed at the 12.4%. So this gives him $6,510 of OASDI that he needs to remit, and 1,740 of HI that he needs to remit. He did not cross that 200 mark threshold because the 60,000 and the 700 or 74,700 is only 134,700. So he is not subject to that supplemental HI. And we will go ahead and end this specific lecture right here because we've really talked about the who. Who is an employee? How do we determine who's an employee? And we know the percentages that are applicable on whether they are self-employed or it is coming from an employee-employer relationship. We will pick up in the next lecture and start talking about wages. What is a wage? How do we determine what is wages? Because there's a lot of different things that contribute to wages beyond just the hourly rate that an employee may receive.